Hey, good morning, everybody. Well, I presume actually it is actually afternoon rather than morning. But the sun is up. It's pretty good down here in London. So wherever you are, I hope it's good. Well, welcome to this preview of this weekend edition of the Traders Club. Ultimately, so again, we'll be launching the Traders Club in about the next couple of months, and we should have everything on the website pretty soon, and you will start to get lots of bits of streams of information. So essentially, this is going to be our proprietary outfit, and we're going to have a live trading room, and we're also going to be doing a lot of transformation programs. So it should be good fun. But anyway, what I wanted to show you today was take a look at some of the trading strategies that I kind of look at and what I trade with, and just sort of give you an idea of what's happening in terms of where we sit in the market ultimately. Well, before I go ahead, I'm long Euro Yen, right? Because I think that was a really good trade. I'm like 100 pips up, so I'm looking for 139 on Euro Yen, at least 139, 139.40. But we shall see. I'm starting to think that the bullish run that has been happening in the euro is starting to cool off, and I'll tell you the reasons why. A lot of my reasons, or why I've come to that conclusion, is when I take a look at the futures market and I look at what's happening in there. I'm starting to have second thoughts as to whether the euro can sustain ultimately the upward rally. But for another discussion. But for now, let's take a look at some of the trade. As you can see, I've got a very clean chart. Now, to be perfectly fair, what I tend to stick on my chart, so now you're looking at cable, is I would normally put on a moving average or two. So let me stop over here and pick out some of these indicators, and let's see if we can make some adjustments. So let's see, exponential moving average, usually on my chart, and I usually make it yellow. All right, so there we go. So this is a significant line. The 200 is significant for me. I'll normally stick on a 55 because I like to gauge momentum. But for now, for the purpose of this specific video, I'm going to keep it exactly what it is with just a 200 exponential. Well, in this case, sterling, which has been quite strong, has broken over the 200 exponential. So for another day, we shall come to that. Now, ultimately, volume. What is the deal with volume? Now, let's take a look at this. Right, so let's just take a look at this movement here. So as we see, we started around a low point here. Now, what has been happening during this move? We've seen the volume continuously increase, right? Along with the increase in price. Now, for those of you who follow Richard Wyckoff and all the other guys who, Jesse Livermore, the guys who are pioneers of the idea of trading with volume in the markets, you would understand that with rise in volume and rise in price, it suggests a market of strength. So this is the kind of market we would like to buy into. Now, I haven't used any indicator yet. I haven't opened an RSI or any of that stuff. All I needed to see was a progressive rise in volume. Now, entries into the market is always slightly different. Now, based on the idea of supply and demand, I tend to use what's called Fibonacci tool, and I also use the Elliott wave theory. Now, for those of you familiar with the Elliott wave theory, now we know that markets always correct, and they always impulse. Impulse is due to excitement. So people are very excited about the fact that a market is rising or is going to rise, or there's demand essentially. So they buy into an asset, or in this case, they could be shorting. Well, in the case of currencies, even when you're shorting, you're buying something. Okay, so they buy into an asset, right? And then you get this progressive rise in price as of course, as the asset, the value of the asset increases. So obviously we see it go up, and demand increases, price increases, quite natural. So, and then it will correct for various reasons. One could be, players get scared and they exit, or they take profits. The other reason could be people attempting to short the market thinking it's completely overbought. which is absolutely fair. So it is always a good idea, whenever we've seen an impulse, is to trade off the correction. So what I would have done in this case, so we see volume rising, right? It's rising progressively, and we're seeing several green candles. Now, the first thing we got to do as traders is understand the time relationship between an impulse and a correction, right? So in this case, we're looking at this at a higher time frame, mind you. We've seen a progressive impulse over 4 days with a huge move in price. So if we think from the absolute low point to the absolute high point, well, over arguably 3 periods or 4 periods, we've seen a 498 pip move in sterling, right? So this tells us this is an impulse. It took 4 days to do a similar move. Now, if we take this on the other hand, right, which is clearly a corrective move to the upside in this case. So if we were to run it from the absolute low to the absolute high, which, well, let's see, right here. There we go. Right, so we would think well, that's a 363 pip move, so less than the impulse, and it took 6 days just to correct this, and the market continued to correct, even though it was pushing in lower highs. It still continued to correct, which tells us that, well, we're taking too long to essentially cover the move. And if we take the impulse prior, I mean, look at how many pips we moved so let's do this from high to low. There we go, to the absolute low point right here. Well, it was 929 pips. So it's a 929 pip move, and that happened over, let's see how many days? 14 days. Well, there you go. So that's the relationship between time and impulses and corrections. So I'm waiting now for a correction. So I've seen this impulse go up. So I'm going to grab my Fibonacci tool, and I'm going to run it, my expansion, against the correction. But first and foremost, if we hadn't seen the correction, so before I jump ahead, let me run a retracement tool. So I'm going to take my retracement tool, right? Now, providing, of course, we hadn't seen a correction. Now I'm going to bear some targets in mind for this correction. Now, my first idea is that, look, if I correct into the 38.2 or the 50 and then reverse out of it, then it's a good long. Now, to supplement that, I'm going to look at the increase in volume along with the move. Is volume supporting the price move? And if it is, on this correction, I'm looking to get long. So the moment I come in and I test and I reverse and I get over the previous high, yeah. So this is obviously the red candle here is the barrier. So the moment I punch in a new high and I closed on the day at 150.35, then I'll be looking to get long. Right? Despite any struggles, I'll be looking to get long. I know I've got a good position, and right at this point, I can keep my stops very tight at say 148.38 around that region. I can kick it under the Fibonacci 147.93, and it's a good place to hold a stop. Some people will be even more drastic and put it below the actual trough at 145.44, right? Because they're expecting that, well, look, if the market could potentially keep correcting into the 50, 61, 78.6 before actually pulling back. So in order not to get stopped out too early, they might want a wider stop. But it's each to his own, right? If you want to take more, very little risk and hoping to gain a bit more, then that's great. If you want to take on more risk because you're a little bit more sure of the position, then that's also great. So there is no right or wrong way to approach it. It's just what essentially works for you from a judgment point of view, right? So we correct into this level. Now, that's fantastic. Now, what I'm looking for at this point is I'm going to employ the Elliott wave theory. Now, if I'm right, I've seen a first wave, a second wave. I should get a third wave, which should be at least the same distance as the first wave at the very least. But because it's a third wave, I'm expecting it to extend slightly, right? So I know the worst case scenario is equal distance. So I'm going to bear some targets in mind. So if I'm thinking about where to get out of this trade, I run my expansion. And then I look first for the 100%, okay? And that's my first idea, is that if any resistance comes in the market, it will come there. But ideally, I'd want to aim for the 161. Right, so this is where my target's going to be, 156.40, right? So that's 156.40, nice round number. And if I look left, there's some structure here, Right, so I'm ultimately gonna hold my position for here. Right, that's my target. So now I'm long, and the market keeps going up, going up, going up. And I know, well, in line with Elliott wave theory, the market's gonna correct again off the impulse. So now I push over the 100%, I start to reverse. Well, at this point in time, I'm not gonna panic, because now for some traders, this is a perfect opportunity to double their position or add to their line. Right, so the market starts to correct for a fourth wave. That is fine. Now we know, according to the rules of Elliott, the market cannot, so the fourth wave cannot enter the price area of wave one. So in other words, my safety is 150.56, right? So if the price comes under 150.56, then I start getting concerned. I should ultimately exit that position for break even, roundabouts. So at this point in time, I can roll my stops, I'm seeing the market correcting, and I can cover just within the price area of wave one, so around about 150, 150.50 thereabouts, and that's where my stop's going to sit, right? So around about here, right? So the market comes in and touches that, then I'm out. I'm ultimately wrong because I'm not seeing a fourth wave correction, right? The market is probably likely going to keep correcting lower, and it's going to correct here, and then I'll be looking at a range, right? And I'm not seeing an actual impulse, right? So in this case, now the market corrects, gets very close but doesn't get under, and then reverses. Fantastic. So now I'm expecting that we're going to get a fifth. So my target for the fifth is, well, providing now that what looks like I've seen a normal third wave, I'm expecting an extended fifth wave, right? Because obviously the buying is going to be more aggressive. The third wave wasn't very quick, so there's not a lot of profits in here. So the market reverses. Now what happens ultimately during this phase? So I'm going to take a look again at volume, right? So I can see on the bull move, on the next candle of a buy up, volume starts to increase. So we start pushing in 1, 2, 3, 4 bars, volume's increasing, and then finally we push in a major spike, which is the highest spike we've seen for quite some time, dating back to the 12th of November. We haven't seen this much volume traded on sterling to the upside. So this is a good indication that a lot of people have piled in. Now, because the fifth wave is a public participation wave, then ultimately I expect that the public is buying heavily into the move at this point in time, and the move is not potentially going to last. So inside of these, we're going to expect subwaves. So we're going to expect a 1, 2, 3, 4, and a 5 inside of that to complete the fifth, and then we're going to get a catastrophic sell-off. Right, so now we got two choices. Now we can wait for the A correction, which is the first sell-off, and it's going to be quick, sharp, and painful, and should potentially come in to correct the fourth wave. So it should take the price action down back to 150.80, right? Or we can buy into the fifth wave, and the target is for an extended fifth is 160. So at this point, 160.16. Now I'm expecting we should see 160.16 on sterling, even if we get a minor correction at this stage, right? Because why? One, we're above the 61.8, which would have been a normal fifth. And then we've seen a rise in volume, even though as we came into the weekend, the last couple of days, we've seen the volume cool off, which is kind of normal because I'm expecting we're starting to correct. But the propensity or the need to want to sell off this impulse isn't really there, because we can tell, because the volume is quite low. Despite its declining, it's just showing weakness on the bull side. Momentum is weakening, and we should see it correct to collect more buyers. But again, even with the correction, we can probably potentially correct back into 155.36. We could correct it could be quite a shallow correction. We could correct back into 156 and then take off again. So ultimately, we're not going to worry about the correction at this stage. We're just going to stay with it. And then hopefully we come in to test 160.16, and then there should be a mighty sell-off. Right? And then hopefully, the decline begins. And then we could catch that sell-off. But for now, we're going to stay with it because we know it's coming, because the market's got to correct. And we've seen 1, 2, 3, 4, 5 waves, which means that sooner or later we're going to get a big correction, right? And that is the Elliott wave theory. And that's one of the ways that we see hedge funds trading, and that's one of the way we see all the big guys doing it, is they're going down this route. Now, obviously, I run the educational department for a broker in the city, and we see this all the time. You know, I was just watching CNBC the other morning, and there was Mako Financial, pretty big hedge fund, and their bond analyst or their bond trader was using Elliott waves pretty much to predict the Eurobond collapse, right? And he sold off that position, did pretty mighty good because he was losing the Elliott wave theory. So hey, it's life, right? That cannot be ignored. I mean, that's how we trade. That's how we've learned to do it, and that's the best way to get into good long-term positions without kind of biting your fingernails, right? So the Elliott wave theory for me pretty stands, but I also want to keep an eye on volume because volume is key. Right, so this is the idea around stalling. So maybe we see 160. Very good chance at this stage. I mean, we're at 157.28. I wouldn't buy into a move. The move's extended. I'll probably wait for the sell-off. You know, it's a safer position for me. Less risk, high probability trade, and that's the kind of stuff I like. But ultimately, so that's the picture, right? For cable. But this should give you an idea of how we look at trading. Now, if we wanted to kind of take a deeper look into what happened over the price action over those days, we can sink into the time frame. So let's drop into the hourly time frame. So we put it into the hourly time frame, and let's take a look at this. So here again, we see these volume spikes. Now, a lot of traders, they ignore this. This is like, I can't believe this sometimes, you know. But they ignore these little signals. Now, let's take a look at this volume spike right here. Now, this volume spike here was a lot of buying activity at this dip, right? So even if we were going to just take our Fibonacci tool and we're going to run it, I can almost guarantee you that was a key retracement level, right? So let's take that swing, right? So we're fairly certain that we've seen an impulse. So again, along the lines of Elliott wave, we've seen an impulse, right? So we know that a lot of people push this price on, and it's going to correct, right? It is going to correct, and it comes into the 38.250, tests it, bit of action, and then we get a big volume spike, right? A lot of people traded into this position. Well, it could be a disguised trade, so this could be sellers trying to push the market lower. It could be buyers, but because of where we are, we're coming off an impulse. I'm more inclined to believe at this level of the correction, this is buying, right? So this is a good opportunity to go long just on looking at this. So we get this price action on this red candle. We should have been looking to go long either at the open or wait for the close of this candle and then go long, right? Now, where would our stops go? Now, again, we could potentially just stick them under the trough, but it could be hunted, right? Our stops could get taken, so we might want to give it a bit of a wide berth and stick our stops there. Ultimately, some people will even go down for the trough at the bottom here. So we get the correction. Market starts to go and it starts to move up. Now, what do we get? Now, the key signal here is that as the bearish movement comes in, we see volume start to break off, and volume is pretty low at this stage, right? It climbs a little bit, but it's fairly low. And then we hit here again, we test, and then the volume peaks and it starts to rise again. So if we take a look at this right now, so again, we see rising volume and we see rising price, right? And it's a bullish move, right? So it's giving us the confidence to stay with the trade, right? And then as we get back into that correction again, we see the volume dropping off. And then it tells us that, well, the sellers are weak. They can't do much. Look, volume's clearly falling off. And then, bam, it peaks again as the buyers come back in. So every time it's giving us this signal that, hang on a second, I want to stay with this trade, right? But really, we're looking at trade off these big signals, these big pictures here that tell us that there's something big going on. Don't know what it is yet, but we know it's big because we're seeing a lot of that stuff going on with the price action. So people are trying to jump in here for some reason, and we don't know why. And it's at the significant low point. So again, we can see these spikes develop as we go. So in this scenario, we've reached a top, right? We see a lot of volume piling. At this point, again, another spike, and the market starts to roll down. So that supports my theory that potentially we're going to see a correction back into the lows again, possibly back into the 155.60 thereabouts, before reversing upwards, right? So this supports that theory that we're just looking at on the higher time frame that the markets are going to correct. But we've seen a weak bearish move, right? So the markets are rolling, but it's really weak. So we have to see if the volume here was selling, if it's going to support the price action down. But because we were coming to the end of the day and it was a weekend, we expect to see volume fall off. So we're not going to read too much into this at this point in time. The real key is come Monday, do we correct off this volume? And if we do, then we're going to wait for the next big spike, which will likely be the clue that the market's going to go higher, right? So this is the idea. So that was just sort of breaking it down. So now we're working through the time frames. Let's take a look at Euro Yen, what I was talking about earlier. So Euro Yen, I still got my Fibonacci on there. I'm still looking for 139.36 on Euro Yen, right? So this should be quite good, right? But going forward, I mean, yeah, this has been a good trade so far. But again, that same idea, right? Already with Euro Yen, we've got a 1, 2. And we have got a bit of a complexity for a fourth, and then we're pushing in for a fifth. Hence, my target is 139.60. However, we're struggling at the 38.2. This could be as well a valid fifth wave, just a short one, and it will mean the decline in the euro will be a bit severe, right? So we should correct pretty much steeply lower if this is the case. However, I'm staying optimistic on the euro because of what I see with the euro futures in the futures market. And also I see there's some potential there. I mean, open interest is declining, so it is suggesting that there's some weakness. But I think we should come in and test these areas before we collapse, right? But I know at this point in time, we're at the top of a move, right? So anything can happen. Now we can break that down a little further. And let's have a look. And we got this guy here. So we're in the hourly frame. And we see a big volume spike supported by a big bullish move. So this may well underpin the price action to the upside. So this again supports my theory that if I'm right, we could see the euro head a lot higher. Now, as we came into the close of the day, we saw a fall off in volume. So there was some weakness in the up move. So I expect a minor correction to find some more buyers and then possibly raise up higher. So again, Monday will be the key determinant of what happens with the price action. So it is really, really important to observe these little spikes because they do take us down. And without these, we're not genuinely witnessing too much of a valid move without validating these strong volumes that come in. So these strong kind of volumes, these real extremes, tend to give us a very good clue, right? And as we can see on the sell side, the most extreme volume we've had has come on this candle here. And it pushed the market lower, but ultimately it was quite weak. And then we recovered on the bull side. There's been not a lot of volume, so there's a lot of market maker activity just kind of pushing this guy up. And then we get a good response here from volume slightly higher, and then we've got the biggest response since as we're topping out. So there will be a lot of people trying to take sell positions in here as well. This wouldn't just be buyers, but it's a good signal that it's potentially we are going to push higher, and the buyers will likely want out considering the price has moved considerably from the last time we saw this spike. So that is it, guys. That is it. Well, there's a lot you got to overlay. I mean, for myself, I do a lot of ratio analysis. So it is not just about looking at the charts and looking at the volume. I don't have tunnel vision with trading. I mean, I've got multiple screens. I got more looking at multiple markets because I'm aware of the correlations, the intermarket relationships. I'm aware of capital flows. So trading is a lot more than just having tunnel vision and just looking at one chart and just trying to trade it to death. It is doable, but ultimately we want to have a three-dimensional view because we want to know what asset we want to move into, and we want to gauge sentiment. Is the market risky? Is it risk averse? If it's risk averse, is it better buying into safe haven assets like the yen or like the US dollar maybe, or perhaps is it a good idea to buy into bonds? If market's really risk averse, are we experiencing inflation? So are we going to buy into gold? If there's expected inflation, then of course gold prices are going to go up. It's a hedge against inflation. So we want to look at specific things if we're going to trade successfully. We can't trade anymore. The markets are not that way. We not hope to trade the smaller time frames even without an understanding of capital flows. There's no fucking chance. If you try to trade just narrowly, just one chart, I mean, there are high frequency traders out there. They're going to kill you. They're going to kill your stops. They're going to kill you all over the shop. Because you have no idea what is going on in the market. You think you do, but you absolutely don't. Because you have no idea what is going on in related markets that could potentially influence your market. So you have no clue. You're basically taking wild bets and you're thinking that they're going to work out. In fact, you probably convince your strategy works. But that's the way of the world, That's why markets are tricky, and that's why 90% of people fail, as they say. But ultimately, it's because there's just no dedication. There is no dedication to work your way and put the time in, put the work in to get your positions right. There's just a lot of, that was a good trade. I'm taking it off the Fibonacci. It's all about the bat pattern and the cipher pattern and all that other stuff. But there's nothing really substantial around capital flows, money management, supply and demand. It's just really about taking some signals, a lot of pattern recognition, which is good. It's a great way to trade. I mean, you're doing something right, but if you want to be successful on the long term, you've got to learn a little bit more than just, patterns. But guys, have a wonderful weekend. Like I said, we're long euro yen at the moment. So that's turned out to be a really good trade. I've been very bullish on gold for a long time just because I'm expecting inflation. So that's my secret. I'm expecting that the drought in California is going to have a big impact on commodities. So we're probably going to see some food price inflation. If that is the case, this will be reflected. It will be a cue for the Fed to go for interest rates eventually, but not before I think gold goes up to about $12.50 an ounce on expected inflation, because that's probably going to run around for a while. Right, the Fed will be able to hike rates, and I think this is all going to center around the California drought. But that being said, I'm expecting all the big commodities to race up. I've been looking at the futures market data quite closely. So this will feed into currencies eventually. So as a currency trader as well, I'm keeping an eye on it. But guys, have a great weekend, and I hope that we could do this again. Right. A video has always been due. I haven't posted one for a while, so I hope you guys can enjoy. And I look forward to at some point updating you guys on what we're doing with the Traders Club.